So, as part of general awareness for IBPS examinations, under that we are learning banking awareness. So, under banking awareness, in this episode we are going to learn about Reserve Bank of India and its functions, as well as monetary policy and tools of monetary policy. So, RBI's monetary policy revision will be taking place for each quarter in a year. So, what is this monetary policy actually? So, what are the roles and objectives of monetary policy? What are the instruments used under monetary policy to control the inflation or to maintain the price stability? Okay. So, all these things will be learned today. So, Reserve Bank of India is the central bank of India, which is having the authority to control the monetary policy of this country. So, every country will have its own monetary policy, which is being controlled by the central bank of that country. In India, it is the Reserve Bank of India which will formulates and implements the monetary policy here. So, what is monetary policy actually means? So, monetary policy is a tool which is used to influence the interest rates, inflation, and also the credit availability through various changes in the money supply, okay, available in the economy. So, therefore, monetary policy is a measure of tool, okay, which is used by the Reserve Bank of India in order to control the key interest rates as well as to control inflation and also to see that whether the credit is available, okay, credit available is there in the market, okay, so that we can balance the supply of money as per the demand in the market, okay. So, in India, when it comes to India, we call the monetary policy also as the credit policy, okay, because you see we have different policies here, like monetary policy which is being prepared by Reserve Bank of India, and then fiscal policy which is being prepared by the government of India itself under the Ministry of Finance. The next, revenue policy which is being prepared by the government of India with the help of Reserve Bank of India again, and the credit policy, okay, which looks after availability of credit by the Indian banks, nothing but the commercial banks within the market, which is also monitored by the Monetary Policy Authority of Reserve Bank of India. So, therefore, monetary policy or credit policy both are prepared by RBI. So, when we speak about this monetary policy development in India, so it was first a controlled expansion. So, under Reserve Bank of India Act 1934, okay, so this monetary policy was introduced in order to control the depreciation or devaluation of rupee. Okay. So, the rupee was devaluated after independence in the year 1948. So, in 1947 we got independence, in 1948 the rupee got devaluating. Okay. So, the controlling of rupee was has become a major problem for Reserve Bank of India. So, therefore, it has thought to introduce a monetary policy during 1951 onwards. So, controlled expansion was followed from 1951 to 1972, and to maintain the momentum of economic growth. So, this will stabilize the prices as well as it will rise the national income and the per capita income of the people, nothing but the living standard of the people will also be increased. And another one is, since 1972 onwards, RBI's anti-inflationary policy is being followed with the help of monetary policy itself. And we also read about Chakravarti Committee suggestions on monetary policy. Okay. So, what are the main objectives or tools of monetary policy? So, the main objective of any monetary policy of any country is to maintain the price stability of the country. Okay. So, RBI will formulate and implement the monetary policy, okay, each year for like annual year in order to maintain the price stability, so that adequate flow of credit to the productive sectors of the economy will be supported, and that it will increase a rapid economic growth, and also balance of payments will be equilibrium, and to provide full employment or to decrease the unemployment. So, low unemployment is also one of the objectives of Reserve Bank of India. So, equal income distribution is also one of the option for objectives or tools. Reserve Bank of India, okay, with the help of this monetary policy, will control the total banking system in the country, so that the inflow or outflow of rupee, that is nothing but money, is completely monitored by the central bank. This will help to boost up the markets in the economy to balance the demand and supply. So, it can be effective only when we control the prices, nothing but price stability is the main objective of Reserve Bank of India as of today, okay, so that it can control the inflation as and then. If inflation is maintained as per the predictable rates, then we can achieve the market stability, price stability, then also economic growth. So, what are the methods or tools of this monetary policy? You see, the Reserve Bank of India aims to achieve its objectives of economic growth and also to control inflation through two methods. Okay. So, those are general or quantitative methods. Selective or quantitative methods is to measure that is monetary policy's key rates, okay, through open market operations or deployment of credit. So, before going into the subject, how these qualitative and quantitative measures are being used as a tool to control the key policy rates, and in this class as of today, okay, the current monetary policy rates we will be observing here. So, once we observe the current policy rates, the key policy rates, which are the very important tools to control the money supply in the market, so that we can control the price stability of each and every product as well as the mentality of the purchaser. Nothing but public can be controlled here. The key policy rates are reviewed by Reserve Bank of India. So, the new key policy rates are as under. So, repo rate, it is at 6%, reverse repo rate 5.75%, bank rate 6.25%, MSFR rate is 6.25%. MSFR means marginal standing facility rate. So, this rate is equal to or directly proportional to bank rate. And then reserve rates, CRR at 4%, nothing but cash reserve ratio, and SLR at 20%. So, what are the meanings of these key policy rates will be discussed in this class, okay, following. So, what is a repo rate, reverse repo rate, bank rate, MSFR rate, CRR, SLR, okay, what is the meaning, what actually the Reserve Bank of India will do with these tools in order to control the money supply, okay, fine, we will see in this class itself. So, then what are the lending and deposit rates? So, as it is key policy rates and then reserve rates, now it is lending or deposit rates. So, base rate, savings rate and term deposit rates. So, these three are the lending or deposit rates which are fixed by Reserve Bank of India. So, base rate is nothing but 9% to 9.55%. Savings rate is at 3.50 to 4%. Term deposit rate at 6.25% to 6.75%. So these lending rates nothing but which are lent by the banks, commercial banks to the people, and deposit rates nothing but where the people will deposit their money, okay, maybe under savings or in term deposits, okay, into the with the commercial banks will also be decided by the Reserve Bank of India. Okay, so therefore the Reserve Bank of India will change these key policy rates as and then required based on the demand and supply of money supply in the market, as well as if the Reserve Bank of India finds that inflation is rising, okay, than its predictable rates, then also it will change these key policy rates. Or else if inflation is declining rapidly, okay, which is harmful for the market, nothing but trade or transactions, then also Reserve Bank of India will change these key policy rates. Okay. So monetary policy will be formulated and implemented by Reserve Bank of India from April to March, 1st April to March, okay, as a financial year, as well as it will review this monetary policy for each quarter. Okay. So each quarter, in the sense we have 3 months for each quarter, so 4 quarters we have right now. So each and every quarter Reserve Bank of India will monitor the key policy rates of Reserve Bank of India. Apart from that, if the situation demands based on the inflation, that nothing but high prices are in the market, then also it can change the key policy rates. Okay, fine. So apart from these key policy rates or these reserve rates or lending or deposit rates, exchange rates, okay, following. So the foreign forex market exchange rates will also be decided by Reserve Bank of India only. Okay, following. So INR, so Indian rupee against $1 is currently, as per today it is, okay, 64 rupees and 1048 pice. Okay, and for 1 euro of European Union, as euro is a common currency of European Union, okay, 28 countries are the members of European Union, and euro is a common currency of these 28 countries. So 75 rupees 20 pice is the market price as of today. Okay. Next, INR against 1 pound sterling of UK, United Kingdom, is 82, and for Japan's yen is 58. So these rates will be changing, fluctuating, okay, day by day. So day after the day, based on the market, based on the Sensex, based on the inflation, okay, based on the FDI or etc., or nothing but the government schemes, etc., the exchange rates will be changing, fluctuating every day. But when it comes to the key policy rates or lending rates or reserve rates, these will be changed by Reserve Bank of India only, okay, for each quarter or else on the demand. But coming to the exchange rates, this will be changed every day, okay, that is based on the demand and supply of the market, supply of money in the market, inflation targets, FDI, that is FDI flows in the market, and then the government's policies. Okay. So when it comes to the monetary policy measures, it is the general quantitative method as well as the selective qualitative methods, as we learned in the previous slides. So here you see, in these general quantitative methods, the total quantity or volume of credit of money supply in the market is being read and controlled. So we will be observing the total quantity or volume of money supply in the market in quantitative methods. So how this can be seen? So how can we measure the total volume of money supply available in the market or in the economy? So through open market operations or deployment of credit, as well as through the flow of money from Reserve Bank of India to commercial banks to the public, or commercial banks to RBI. Okay. So there will be an agreement Okay. So, a memorandum of understanding will be there in between the Reserve Bank of India and the commercial banks. So, regarding the flow of funds, okay, between the central bank and the commercial bank, nothing Reserve Bank of India and the other commercial banks which we are seeing right now, like State Bank of India, Allahabad Bank, Axis Bank, ICICI Bank, okay, etc., etc. So, any of the commercial banks, maybe it is public sector banks or private sector banks. So, OMOs, so open market operations, what they do in the market, it is nothing but these OMOs will indicate the buying and selling of government securities in open market to balance the money supply in the economy. So, here the buying and selling takes place in open market operations. So, where these buying and sellings takes place? So, how it takes place is very, very important. So, what are those government securities is very, very important once again. So, government securities like government bonds, treasury bills, okay, and other securities will be issued by the government of India to Reserve Bank of India for creation of credit. So, that Reserve Bank of India will provide some money to the government of India for its maintenance. Okay. So, in this agreement, the securities will stand as a surety between Reserve Bank of India and the central or state governments. So, here these securities or sureties will be issued in the market, in open market for buying and selling. Okay. So, that the money will be flown from Reserve Bank of India to bank government or government through Reserve Bank of India. So, this is the thing which we need to understand here. Okay. So, buying and selling of government securities in the open market in order to create the money. So, credit creation is a key point which plays a major role in the supply of money. Next, deployment of credit. So, as I told you, Reserve Bank of India has various measures to deploy credit in different sectors of the economy. So, this credit availability or credit creation within the government of India, okay, with the help of Reserve Bank of India takes place in order to fund or lend to various sectors of the economy, okay, like agriculture, industrial sector or exports, etc., etc. So, majorly you see for agriculture loans, that is farmer loans, agri loans, kisan credit cards, okay, or else the securities which are issued by NABARD, etc., etc. Okay. So, here the credit will be created and it will be transacted from Reserve Bank of India to Government of India and Government of India to Reserve Bank of India. And coming to another quantitative tools by Reserve Bank of India, you see bank rate, so which is at 6.25%. So, bank rate is the rate at which Reserve Bank of India allows financing to commercial banks, nothing but lending loans to the commercial banks. So, bank rate is a tool which RBI uses for short term purposes. So, if the banks are having any necessity of funds, they will get money from RBI under NDTL, net demand time liability. Okay. So, based on a fixed interest rates, the commercial banks will get loans from the Reserve Bank of India at bank rate. Okay. So, if the bank rate is increasing or if the bank rate is high, it becomes very hard for the commercial banks to get money from RBI. The bank rate at present is 6.25%, earlier it was 6% only. So, if it is increased to 0.25% as per the recent statistics means RBI does not want to lend more money to the commercial banks. So, in case of necessity of funds, the commercial bank gets loans from RBI at the rate of 6.25%. What is MSFR then? Marginal standing facility rate is the rate at which RBI lends loans to the commercial banks on overnight basis, and this MSFR rate is directly proportional to bank rate. You see, whenever the bank rate changes, okay, so even MSFR rate also changes. If the bank rate is at 6%, MSFR rate will also be at 6%. So, what is the difference between bank rate and MSFR rate then? So, bank rate is the rate at which the RBI allows loans to the commercial banks or finance to the commercial banks, okay, for a particular time period. Okay, it may be a 1 month, 30 days or 90 days or 180 days like that, or 365 days. But when it comes to the MSFR rate, commercial banks will get loans or RBI lends loans to the commercial banks on overnight basis, means today as of urgent requirement. Okay, if the commercial banks needs money, it can get loans from RBI at MSFR rate. Okay, so this MSFR rate is calculated on daily basis, overnight basis. Okay, fine. The funds may be minimum 1 crore rupees also. So, if it is 1 crore or 10 crores or 100 crores or 1000 crores, that depends. Okay, that depends on the requirement of the commercial banks. So, this MSFR rate is the rate at which RBI lends on overnight basis. Very urgent requirement is there for commercial banks. They get loans on MSFR rate only. Okay. When it comes to the other quantitative tools, we see the repo rate. Okay. So, repo rate as of today is 6%. Okay. For the next time it may change. Okay. So, while the examinations point of view, you please consider these rates. So, you please refer Reserve Bank of India's website like www.rbi.org or Reserve Bank of India .org, and check the key policy rates once before your examinations. It may change. Now it is August and the exams will be in the month of November and December, where general awareness topic will be there in the mains of IBPS or SBI or NABARD examinations. So, general awareness and banking awareness topics will be there only in mains part, not in prelims part. Okay. So, therefore, in the month of November or December, automatically the key policy rates may be changed, and the examiner will be asking you the current key policy rates as of the date of examination. So, if it changes, okay, fine, you people may get negative marking there. So, please kindly check out. Okay. So, as per today, okay, the key policy rates are mentioned here. It may be changed. So, kindly check it. Okay. So, coming to the repo rate is the rate at which the Reserve Bank of India lends short term money to the commercial banks. So, as of the requirements for urgent day, it is MSFR. For long term, it is bank rate. If it is for short term like 1 month or 2 months, they get money on repo rate basis. Okay. So, it is at 6% as of now. So, whenever the repo rate increases, so borrowings from the Reserve Bank of India becomes more expensive. So, if the commercial banks are running on deficit basis, so they are require of hard money right off now. Okay. So, they get loans. If the loans, if they go to the Reserve Bank of India to get the loans, if the loans are very high, so they cannot get loans and they cannot lend loans to the people, okay, as per the predictable rates. So, if it is increased, the borrowings becomes very harder. If it is decreases, the borrowings becomes cheaper, isn't it? So, it becomes more expensive as well as vice versa. So, repo rate is what is the meaning of repo here? It is nothing but repurchase rate. Okay, so repurchase agreement. So repurchase of securities by the commercial banks to RBI. Okay, so the commercial banks will purchase the securities from RBI at 6%, so that Reserve Bank of India can lend money on this basis. Okay, so the interest rate will be fixed, which is called repo rate. Coming to the reverse repo rate. Reverse repo rate is another tool by Reserve Bank of India in order to control the money supply. So it is one of the major tools of monetary policy, we can say, because it is the reverse in which that is Reserve Bank of India will borrow the loans from commercial banks. So here you see, normally we people, common people, will get loans from commercial banks, okay, and the commercial banks will get loans from Reserve Bank of India, as it is the largest lender and banker to the banks. But in reverse here, Reserve Bank of India will borrow loans from commercial banks, which is called reverse repo rate. So what is this reverse repo rate here actually means? So why the Reserve Bank of India will borrow loans from commercial banks is a question mark, isn't it? So if commercial banks are running out of money, they get more, and that is nothing but they get loans from Reserve Bank of India. What if the commercial banks having more money? They can fund more money to the people. In such case, if more money is funded to the people, loans will be utilized. If more funds are available, automatically what happens? People will start buying and buying. If purchasing power parity, okay, purchasing capacity is increased, people won't think of prices. They will just buy the products, okay, fine, and they will use it. Meanwhile, that product's demand increases, that product's supply decreases, which will affect on the price. Okay. So here the market trend is like this: if supply decreases and the demand of the product automatically increases, as well as the price of the product will also increases. If the price of the product increases, it is called inflation. If inflation gradually increases, keep on increasing of a particular product. Okay. For example, take tomatoes or onions in the market. Okay. If onion prices are at 20 rupees or 40 rupees, the people can purchase it. They are affordable to purchase it. But if onion prices are at 100 or 200 rupees per kg, so they cannot purchase. What happens is the trade decreases and the transaction declines on the onions. It will affect on other products also. If all the products are high, very high, so automatically the due to inflation, okay, the people won't start purchasing. The market will collapse and inflation increases, which will affect on the economic growth of the country. Okay. So in this way, the reverse repo rate is being controlled. Okay. So we will see how it affects the market in the next episode.